It's my time of the month, which means it's inflation's time of the month, which means we need to make a video on this last Wednesday's report on monthly and year-over-year inflation. We got the number for August, and honestly, it looks like it continues to ease. The Consumer Price Index, or CPI, rose 2.5% from a year earlier in August, down from 2.9% in July. And this marks the 5th consecutive month of cooling inflation. Now, core inflation, which excludes the more volatile food and energy prices, remains steady at 3.2%. And economists had anticipated an inflation increase of 2.6%, along with the 3.2% increase in core prices. Now, of course, the ongoing conversation that we've been having on the show and everyone in the world of economics has been having is around the Federal Reserve rate decision. And this cooling inflation likely shifts the Federal Reserve's focus from inflation to the cooling labor market, which has shown signs of softening hiring and potential economic deceleration. Now, firmer shelter inflation contributed to stronger than expected core price increases, which could complicate the Fed's decision on the size of its rate cut. Analysts predict that the Fed will lower rates by 0.25 percentage points at its upcoming meeting, though a larger cut of 0.5 points in November or December is still possible. And then when the report came out, major stock indexes fluctuated throughout the day, with the S&P 500 falling as much as 1.6% before closing with a 1.1% gain. And the 10-year Treasury yield increased slightly to 3.653%, remaining near its lowest level of the year. Some traders are betting on multiple cuts that could reduce rates by more than 1 percentage point over the year. But the decision rests with Fed Chair Jerome Powell, with the emphasis shifting from inflation to labor market health and future cuts. What did we see in energy, housing, and consumer spending? Oil prices have declined, suggesting that gas prices could continue falling in the coming weeks, but the housing market continues to grapple with elevated shelter inflation. But experts predict a slowdown in price increases as more renters sign new leases, which could help push inflation toward the Fed's 2% target. And despite slower inflation, the cost of living hasn't decreased substantially, as many families continue to struggle with the lingering impact of prior inflation spikes. And then there's the impact on retail and consumers. Major retailers like Target and Amazon have responded to inflation by cutting prices to attract price-conscious shoppers. Consumers are searching for deals, but spending has not dramatically decreased. And Walmart CFO John David Rainey has noted that there hasn't been any significant decline in consumer health, as spending remains robust despite inflationary pressures. Now, of course, the spending and housing and inflation and economy means nothing without the labor market. And as we've been talking about, the labor market has been cooling with slower hiring and wage growth, while at the same time unemployment durations have increased as people are taking longer to find jobs, and the average spell of unemployment is rising, adding stress to the overall job market. And we can put all of this together in the chaotic 2024 election, as inflation remains a major issue for voters, with higher prices for food, energy, and housing being significant concerns, especially in this 2024 presidential race. Easing inflation has provided some relief, but concerns remain about how much progress has actually been made and whether the labor market can sustain its recovery. And Americans are really looking to the Fed's decision, and this is because it impacts interest rates for everyone. It has broader implications for consumer loans, mortgages, and credit cards, with many Americans eagerly awaiting relief from the higher rates. But inflation was a global issue, and with our allies over in Europe, we saw high inflation and rate increases. But just a couple days ago on Thursday this week, we saw major changes continue within the European Union. There, we saw the European Central Bank, or ECB, lowering its key interest rate by 0.25 percentage points from 3.75 to 3.5%. And this is the second cut in just 3 months, highlighting a shift in focus from fighting inflation to supporting economic growth in the Eurozone. And this move widens the gap between the ECB and the Federal Reserve in terms of monetary policy, as the Fed is also expected to begin cutting rates pretty soon, but hasn't yet. Over the next 12 months, markets expect the Fed to make about 10 quarter-point rate cuts and the ECB to implement 7 cuts, according to Refinitiv data. Now, we're about to talk about the United States economy in a bit, but first, the European outlook is not looking great. The president of the ECB confirmed that interest rates are on a declining path, but the speed and extent of future cuts will depend on economic data. And the ECB revised its economic growth forecast. 2023 GDP growth for the Eurozone is expected to be 0.8%, down from an earlier forecast of 0.9%. And 2024 growth is projected at 1.3%, revised down from 1.4%. 2%. And at the same time, the ECB also raised its inflation forecast. Underlying inflation, excluding food and energy, for 2023 is projected at 2.9%, up from 2.8%. In 2024, inflation is projected at 2.3%, slightly higher than the earlier forecast of 2.2%. Europe's economic recovery is slow, with Germany, the largest economy in the Eurozone, struggling with declining industrial output, putting it on the verge of a recession. But wage growth remains pretty robust in both Europe and the United States, which supports household spending but complicates central bankers' efforts to bring down inflation to its target levels. The former president of the ECB issued a report outlining deeper challenges for the European Union, focusing on the region's productivity gap with the United States. He argued that the EU needs to invest 750 billion to 800 billion euros annually to close the productivity gap. And failure to boost productivity would lead Europe to face tough choices, potentially forcing it to scale back on its social model or other ambitions due to a lack of financial resources. But let's go back to the United States. Are we still headed for a soft landing, or are we about to see a hard landing? As a full-time creator, I can tell you creating engaging videos takes a lot of time and effort. From scripting to editing, the whole process can be a headache. But that's where InVideo AI comes in. With InVideo AI, you're in the director's seat while the AI acts as your co-pilot, taking care of all the heavy lifting. InVideo AI is the world's most used AI video creator with over 10 million users in more than 150 countries. It's the only tool I found that lets you control every aspect of your video using simple text prompts. So here's how it works. To start, you enter in a detailed prompt. For example, create a video about the best purchases you can make in your 20s. InVideo AI will generate a rough draft based on your input.
None of us really know how to adult, right? So let's figure out the must-have buys for your 20s together.
If you need to make changes, it's as easy as typing. You can add subtitles, change the voiceover, or even modify the intro with just a few text commands. Want to change the language to French? Done.
On est tous un peu perdus quand il s'agit d'être adulte, pas vrai? Alors découvrons ensemble les achats indispensables de la vingtaine. Tout d'abord, un matelas de qualité.
Need better footage for a scene? Done. It's that simple. And here's the game changer. InVideo AI can clone your voice. Imagine creating videos in your own voice without having to record anything. This feature alone saves you time and money, making video creation more accessible and efficient. Once you're happy with your video, you can export it without watermarks and with access to high-quality stock footage. This comprehensive tool replaces the need for multiple apps, saving you hundreds of dollars each month. So if you're serious about upping your video game, try InVideo AI. Plans start at just $20 a month, and you'll get access to millions of royalty-free stock footage clips, voice cloning, and more. Scan the QR code on the screen or check out the link in the description and use my code YourWeekInMoney50 to get 2 times the number of video generation credits in your first month. Now, when it comes to recession fears, 2 years ago, the yield curve inversion was seen as a strong indicator of a coming recession. Now, the yield curve has uninverted, meaning short-term yields have fallen below long-term yields again. And this shift is also viewed by some as a recession signal driven by Federal Reserve interest rate cuts. Historically, large Fed rate cuts often signal a recession, or they happen when the economy is already in a recession that economists may have missed. And investors are interpreting the Fed's action in 2 ways. Scenario 1, the Fed is cutting rates because the economy is weakening, particularly the labor market. This would be bad news for stocks as it could lead to a recession. And scenario number 2, the Fed is cutting rates because inflation has cooled and growth is stable. This would be good for stocks because it allows for cheaper financing without significant economic contraction. Now, obviously, the market is hoping for a soft landing, where the economy slows but doesn't enter a recession. Examples of soft landings occurred in the mid-1960s, mid-1980s, and mid-1990s, despite major rate hikes. However, those periods involved either mild or no yield curve inversions, unlike the current situation where the curve was deeply inverted for 2 years. But different yield curves provide different insights. Economists prefer the 10-year minus 3-month yield curve, which is still inverted, and that has a stronger historical track record than the 10-year minus 2-year curve used by many investors. The 10-year minus 3-month yield curve is still far from uninverting, adding to market market confusion about the economy's trajectory. Some analysts believe investors are overpricing the likelihood of deep rate cuts while expecting a soft landing, ignoring factors like upward pressure on long-term rates from permanent fiscal deficits, also increased defense and energy spending due to global geopolitical tensions, and also protectionist policies contributing to long-term rate increases. If inflation stabilizes near the Fed's 2% target, interest rates of around 3% are conceivable for a while. The lingering question remains, is the economic slowdown a natural return to normal post-pandemic, or is it a precursor to a full-blown recession? It's hard to know because recent economic data has been mixed, but there's no immediate sign of an economic collapse. Corporate investment is slower in some sectors, but government subsidies have encouraged significant factory building and capital spending despite higher rates. I mean, the economy is less sensitive to interest rates than in the past because many debts, both corporate and mortgage, are locked in at a low fixed rate for longer periods. And this insulates both businesses and homeowners from the full impact of higher rates, delaying the effects of a Fed rate cut on the broader economy. So in the end, the yield curve indicates that the Fed is about to cut rates, but it does not definitively answer whether a recession is imminent. Investors and you and I should be cautious about relying too heavily on yield curves as the sole predictor of a recession. I honestly believe that you guys, everyone around me, everyone in our lives can really take control of their futures and change their entire financial life. And we've spent over a year putting together the tools you need to get there. Right now, our budgeting program and investing program are bundled at a 15% discount, plus you get a $100 cash reward gifted to you right into your Moo account. The time is now to take control of your financial future. Do not miss this opportunity.